Thank you all for your engagement. A few housekeeping notes. We will keep this discussion as close to an hour as possible. Please send your questions for the panel using the Q&A functionalities throughout the speaker's discussion. We will address as many as possible during the last 20 minutes. Now, I'd like to introduce our moderator, Michelle Perry, Director of ODD, ESG, and Sustainability Officer at Aksia. Michelle, over to you.
Hi, everybody. So I lead the ESG integration efforts at Aksia, and one of our biggest challenges is having clients all around the world and with different perspectives and trying to meet their needs in terms of ESG. And we've tried to tackle it in three main ways, looking at ESG integration, flagging ESG risks and opportunities, and sourcing good ESG ideas for our clients. But in light of these recent events, that we've been going through with COVID, we've definitely felt like ESG has become an even more urgent matter. And today I'm delighted to be joined by two fantastic experienced leaders in the ESG space from both sides of the Atlantic. We have Dewi Dylander, who leads the ESG and sustainable efforts at PKA, the third largest pension fund in Denmark, and Jake Barnett, who heads engagement for Wespath. They manage the pension funds for the United Methodist Church. Both organizations do a tremendous amount in ESG, are very sophisticated and advanced, and I'm really excited to hear their personal views and how their organization has approaches ESG. So with that, I'll turn it over to Dewi. You can provide an introduction to PKA and their approach to sustainable investing.
Thank you very much, Michelle, and well, good afternoon if you're in Europe, and good morning if you're in the US. I'm the Deputy Executive Director of PKA, one of the largest pension funds in Denmark, and I'm heading the Sustainable Investment Department and also a small investment secretariat. We've been working in PKA with ESG, sustainable investments, sustainability, impact investments, or what you would like to call it, for a number of years, and I'd be happy to share those with you. I've made a small presentation that we can run through. Yeah. Okay, so one of the largest Danish pension funds. We are member owned. We have 320,000 members, and they are primarily from the health sector. So that's nurses, midwives, and so on. Our asset under management, just one back, please. Our asset under management, well, it's not that big compared to US, but for Danish size, it's fair enough. So $50 billion in asset under management last year. We've dedicated 10% of those to climate-related investments by the end of this year. And as you can see, we are on track right now at around 4.8 billion, sorry. And we aim to increase that going forward to 2030. I won't go through all these guidelines and policies, but they guide us in our work, and that's why I think it's important to mention them. I like to draw your attention to a couple of them. As you can see, we have weapon restrictions and tobacco restrictions. So there are certain areas where we say within controversial weapons and tobacco, we don't go into those sectors at all with our investments. We also have a coal restriction. Back in 2015, the boards decided that it should be a 90% target. So if a company has makes a return for 90% or the business is around 90% or above from coal, we don't expect those companies to be able to change to something else that will be Paris aligned. And we just decided a month ago within the boards to get that limit down to 20%, thus also excluding a lot of coal companies. We have a tax policy. We adhere to the Paris Agreement. We support it, and we also try to integrate its goals into our investment strategy. And I don't want to go further into this time permitting. Yeah. So if I should just really sum up very narrowly, what is it? How is our approach to responsible investments? Well, we have an active dialogue with companies. We believe in active dialogue, both ourselves, but also engaging with other investors within the companies that we invest in. And if they are in breach or there are controversial things that we see, then we will talk to them through this dialogue. We use our voting rights at the AGMs. And also have an exclusion list of almost 300 companies. So again, as I mentioned, there are entire sectors that we exclude, but there are also some activities, some companies that are excluded based on their activities, like the coal companies, but also oil and gas we look at. So investment strategy, 10% going to climate-related investments, and that's primarily wind, both on and offshore, solar, biomass, but it's also buildings and green bonds. We are actively engaging both with the political system, but also with major organizations like the PRI, the IRGCC, and so on. And we also engage through Climate Action 100+ with the 161 biggest CO2 emitters, and find that there are very good progress taking place in a number of companies. And sorry, and just the last one. Finally, the whole concept of openness and transparency, that's something that we value in the companies that we intend to dialogue with, that we invest in. So that's something we try to do as well ourselves. Some of the things that we focus on are the TCFD, so the task force on, that's a little bit too fast, sorry. Could you just go back? Yeah, thanks. So just to make the last one, the TCFD, including the portfolio CO2 footprint, it's ESG integration, it's tax engagement, and it's also to looking at what can we do post-COVID-19. For instance, buying social bonds, that's something you were looking into. Yeah, thank you. This is just a little bit more of the same. So trying to push companies in a responsible direction through active ownership. We really believe that focusing on both the ES and the G will contribute to long-term value creation of the companies and the investors. And of course, at the end of the day, if there's not willingness to enter into dialogue, or they are in breach with our policies and guidelines, we have to divest from them. This is just to give you an overview of what we consider responsible investments. And I've mentioned a couple of them: wind, biomass, solar power, green bonds, but we also have investments in microfinance, so supporting women and rural farmers in emerging markets, helping them out of poverty. We have a number of climate-related funds, an SDG fund, where we enter a partnership with other pension funds and also the state. This is just very short to show the travel we've been on. So 2011, it's not that many years ago, but those were our first green investments in an offshore windmill farm. And we're quite a big investor within wind now, having an expertise team in that area. And then this year, and for the last one, there was a collective Danish pension funds pledge at the UN Climate Summit last year. And if you could take the next one, please. Yeah, so the Danish pension sector is not that big. We united, we pledged to invest around $53 billion going forward until 2030. You can see our Prime Minister in the middle. So we attended together with her and a number of other people, the UN Climate Action Summit in New York. September last year, and we presented this Danish initiative and tried to open up. Well, if we can do it in Denmark, then probably there are a lot of other pension funds and financial institutions that could do the same. So this initiative is equivalent to 10% of our, so the whole sector of the Danish pension funds asset under management, and 12% of our GDP. And we were supported by a number of international pension funds, including the New York State Common Retirement Fund, PFZW from the Netherlands, and Storebrand, which are much bigger than we are. So if we can maybe inspire others, then great. Just very shortly on the UN Sustainable Development Goals, we consider them really important. Our boards have decided that we should have specific focus on 7 of the 17 SDGs. We're going to host a big conference for around 900 people on this in October. So after my summer break, I'll be fully occupied with preparing that. This is my last slide. It's more or less to sum up on various things. I'll go to the second one, the complexity and adverse consequences. So we try to understand the dynamics of investing responsible. It's not always straightforward, and we also find sometimes these dilemmas that I think all of you know out there. So it's quite easy to get a high-performing ESG profile if we would invest only in Scandinavian companies that are prioritizing sustainability, but we also would like to take sectors or countries that maybe are not that far advanced, and also with our investments try to help them along the way. And at the same time, easy to get a portfolio with a low CO2 level if only investing in sectors with low levels of CO2 emissions. And again, that's not the right way forward. I think I'll pause there. Thank you.
Thanks, Devi. That's a great overview, and I've definitely got a few questions for you. But maybe before we do that, I'll just hand over to Jake from Wespath now to get his view about their approach to engagement and sustainable investing as well.
Yeah, great presentation, Devi, and definitely some of the same principles and practices in our program as what you so nicely laid out in terms of PKA, although I will say there are no pictures of heads of state in my presentation. So I just want to preface that by saying, be ready to be disappointed, people. So moving to the next slide, my role at Wespath is working as a manager of sustainable investment services. And although I'm going to be speaking to our broader sustainable investment practices, within my focus is really on the stewardship and engagement aspect of Wespath's work. And, you know, we consider the analogy that my CIO and I kind of talk about the sustainable investment ecosystem is oftentimes as investors, we are focusing on allocating capital in such a way that we're skating to where the puck is going. And with our stewardship and engagement practices, we're trying to change the direction of the puck to direct more towards a sustainable global economy. And we've actually developed a framework by which we started to think about the idea of what does a sustainable economy framework look like. So in terms of the presentation I'm going to give today is just describing a little bit more the programs and how they fit under the 3 pillars of what we think is necessary to have a sustainable global economy. So in terms of our sustainable investment vision, we define a sustainable global economy as one that promotes social cohesion, long-term economic prosperity, and environmental health. And it's important right now to pause for a moment to say that this isn't just a values-based observation in our mind, it is very much a value-based observation. What I mean by that distinction is this isn't only a reflection of what we see as important in the world from a moral standpoint, but we think that these three pillars are really necessary when it comes to creating healthy and resilient financial markets that are going to support the financial returns that are necessary for us to hit and achieve the goals of our 100,000 participants and 100 affiliated institutional investors that we invest on behalf of the United Methodist Church. Next slide, please. When we talk about the sustainable economy framework, just very briefly, we'll be referring social cohesion. We're really looking at reliable access to basic necessities. Long-term prosperity is about creating equal opportunity, and then environmental health is about creating resilient and sustainable ecosystems. So what does this look like in practice? When we are looking at the different investment activities, the three buckets that we use are invest, engage, and avoid. So you'll see we'll be classifying each of these in one of those buckets in terms of the next few slides. When we think about social cohesion and reliable access to basic necessities, a couple of different programs that we've invested in include off-grid renewable energy access, something that Dewi was referencing, obviously, and some of their investing as well. We also, about 30 years ago, started a positive social purpose lending program, which has now lent out over $2 billion in investments and enabled over 52,000 units to be created or preserved in the U.S. And that is something that really focuses on affordable housing and community development. And that's an area where we see this as an important diversifier in our portfolio. So everything that we're doing with a fiduciary lens within our sustainable investment. And over that time period, the positive social purpose lending has really delivered market rate returns within our fixed income portfolio. With long-term prosperity and equal opportunity, a couple of engagement initiatives that we've taken part in is we've been active in engaging in board diversity and equal opportunity for employment through the 30% Coalition, and here in the Midwest in the U.S., the Midwest Investors Diversity Initiative, focusing more on companies that are locally based here and that we can go and see personally. Those have both been important initiatives for us and remain important in the moment we find ourselves in today, obviously. And then another initiative in terms of equal opportunity that is really front and center with some of the coronavirus epidemic is the work that we've been doing with the Investors for Opioid and Pharmaceutical Accountability. So that originally started as an engagement cohort that was largely emanating out of the Interfaith Center on Corporate Responsibility and was focused primarily on the opioid epidemic. But as time has gone on, we've found that there's important engagement to be done on governance and risk mitigation more broadly within the pharmaceutical sector. And certainly that remains relevant as these companies are the first to be investing and thinking about coronavirus vaccine and how that would be equitably distributed. Next slide, please. So we've spent a lot of time in environmental health as a fundamental pillar. So I'm going to walk through the invest, engage, and avoid aspects of how that work has manifested. Within Invest, we have over $500 million invested into low carbon solutions, strategies that take advantage of opportunities with a low carbon transition. You could also see on our website that we partnered with BlackRock to create what we term as the transition ready investment strategy. And that was really a way of repurposing our passive investments to look at, I don't know if the screen went black for everybody else. I'm just going to keep talking as though I know what's going on. So we'll see if this comes back, but if not, we can certainly get into questions since I've covered a lot of the basics of what the sustainable economy framework is. But within the BlackRock strategy, it's really about creating a lot of data inputs that are going to allow us to invest in companies that are more ready for a transition to a low carbon economy. And then the last piece of sustainable agribusiness is really an area where we've invested over $100 million in both sustainable forestry and sustainable agriculture. I can speak to the engage and avoid pillars of that because that's a lot of my work. So within engagement, we are, as Dewi was mentioning, we are very active in the Climate Action 100, co-lead on a number of companies and are collaborators on others. We also were one of the founding steering committee members of the Transition Pathway Initiative, and actively use that as a tool to inform both our engagement and investment. And then recently joined the Net Zero Asset Owner Alliance. And so on the final slide with avoid, this is an area similar to others where we are looking at thermal coal exclusion, largely because we just see excessive sustainability risk in terms of long-term risks to that sector. And that's, a topic where the tool of management of excessive sustainability risk, I would not be surprised to see that expand in scope and definition as we get better data and understanding of some of the sectors that are going to be challenged moving forward. Although we will always be taking kind of a nuanced approach that is from a fiduciary lens. So to run through quickly on the rest of the slides in terms of future initiatives, a couple of areas that we're going to be focusing on is strengthening our data capabilities. We are having active conversations about the paper that the UN PRI just released regarding aligning SDGs with outcomes in terms of how investments are thought of within a portfolio. That's early stages for us, but has spurred a lot of conversations internally. We are also going to be expanding our impact investment program, which will have the need for better reporting, impact reporting, key performance indicators, and we'll be collaborating with our managers on that. And then looking through on different, the three pillars, if you go to the next slide, for social cohesion in terms of some new areas that we'll be looking at, we're curious to learn more about public-private partnerships and specifically how through engagement we might be able to support public policy that better facilitates those. We will have continued engagement with pharmaceutical companies regarding access to eventual coronavirus treatments, as I mentioned. And then an area of personal passion for me is just transition engagements where you're engaging on the need for a both fast and fair transition to a low carbon economy. I mentioned here in the slide that this is really an intersectional issue. Using the example of engagement with electric utilities here in the US, which is where domestically we're seeing a lot of interest in just transition. Not only is this obviously about reliable access to basic necessities in terms of the need for people to have access to reliable and safe power, it's also about equal opportunity in terms of the jobs that are both created and disrupted as those utilities shift from coal to renewables. And then, the resilient ecosystems and environmental health component of this is obvious in terms of the need for us to have clean electrification of the economy in order to make the transition to a net zero economy. For long-term prosperity, this is an area where we are continually having conversations about what are the opportunities to mitigate rising income inequality as one distinct area of focus. An example of that work that's expanding for us is we recently joined the Human Capital Management Coalition, which is really focused on engaging companies on having better disclosure and adopting best practices when it comes to human capital management. We joined that in the first half of this year, and that's been a cohort of really thoughtful investors that we're tapping into as we think through how we want to respond to the social implications of coronavirus and racial justice. And it's also important to note that within all of these engagement pillars, something that we very actively do is engage with our asset managers. So not only do we do kind of a regular ESG integration survey where we check in on the asset managers in terms of their progress with ESG integration, but we are also wanting to adopt more proactive and forward-looking engagement with asset managers on their responses to specific issues. So for example, we sent a letter to all of our asset managers regarding coronavirus and advocating for them to take certain steps like signing the investor statement on coronavirus response. And we actually had a number of our asset managers let us know that they signed on as a result of our outreach. So we were excited to have that impact. And then next slide. So to finish out, one area that one of my colleagues is going to be exploring is the blue ocean economy. Which could mean any number of things in terms of sustainable use of ocean resources, dealing with plastic, dealing with shipping. That's an area that we have a lot of passion within our constituencies to do some more work on. We'll continue to look at innovative low carbon investments with a specific focus on whether there's opportunities within fixed income. And then having just joined the Net Zero Asset Owner Alliance on the first half of this year, we're excited about the opportunities to learn from what is primarily European peers at this point in time and the thoughtful work that they're doing. We're actively engaging in terms of how we can participate on the mechanisms to create changes to the real economy that help get us to net zero. And the specific subtrack that we'll be working on in that regard is the asset manager subtrack. So with that, I will turn it back to Michelle.
Thanks, Jake. That was a great overview. So many interesting investments. Maybe I'll just jump into a few questions. We'll go back to Davey. And I guess because it's the topic du jour, we can just touch on what is your view, Davey, on how investors in Europe or Australia might differ from their priorities relating to ESG compared to in the States on the side of the Atlantic?
Well, I can speak on how it is in Denmark and Scandinavia, and then just a couple of thoughts. I think in general the perception is within Europe, at least, that the Scandinavian countries, together with a few others like the Netherlands, Germany, and so on, well, they have been on the path for a longer time than some of our Southern European friends. So there's quite a number of differences. So I think if you think about Europe as one, that's not possible. And I know a lot of things are happening in the US. I showed the slide where we were in New York, and we had a very close cooperation before going to the UN meeting with the New York State Common Retirement Fund, and we're really impressed by their work and what they're doing. And maybe they're not so vocal about that. At least we haven't heard about it in Denmark. But we could just see, I mean, the power that is there, and all the initiatives being taken, and because of their asset under management being so huge, it's impressive what they can do. And the same goes for PFZW and Storebrand that we were working closely with. So from our view, getting together in coalitions of investors is really moving something. And Jake, you mentioned as well the climate action 100+ initiative, which is really moving some of these big, huge emitters. And I think that's amazing what they can do, I mean, worldwide.
Great. And Jake, I guess something that we at Aksia we focus on is also evaluating the level of ESG integration at managers. And as time, in the last few years, we've really started to dig, build this out. And I would say, 2 or 3 years ago, we were definitely getting fewer responses. Sometimes people say, what is ESG? They'd never heard of an acronym. Whereas now, almost everyone is responding in some way. Even if they don't have an ESG policy, they're certainly working on or thinking about it in the majority of the cases. But one thing that we've been working on a lot is thinking about how do you, and the question I guess for you is what questions do you ask when you want to evaluate true ESG integration versus that tick the box approach, which we're concerned some people are doing just so they can get to the next level and not be, just tick that ESG box and move on. And in terms of real changing their approach and thinking about responsible investing. And so I guess just around the due diligence around that, what are the main top 3 questions that you would advocate asking when you're evaluating a manager?
Yeah, so within the whole realm of kind of ESG integration and how we think about addressing managers, I think something that's important that we believe is that there is no kind of one size fits all for what good ESG integration looks like. Because obviously, at a very high level, if you're talking about passive versus active investments, we're going to have different expectations of what is being applied. I think that the core principle that I always go back to is how is this materially impacting your investment process in alignment with what you already have as expertise within your investment model. So for example, Wendy Cromwell was had a podcast that she was being interviewed on the Capital Allocators podcast, and she was making this really important distinction of, Wellington as an asset manager is basically housing a bunch of different boutique models. And she was talking about how, one portfolio manager might be really looking for those pivot points by which a company that hasn't historically been strong in ESG is ready to accelerate and do a lot better and improve within, what could be a dirty sector like cement, for example. And that being a perfectly valid engagement model. The other model could be somebody that is just looking for where are the leading companies on the low carbon transition and how do we allocate to those, because we believe that there's going to be accretive and compounding growth because the market has mispriced this risk. And that would be another model that is perfectly valid. I would want to be able to speak to the portfolio manager, hear their entire investment process, and have ESG be something that's being seamlessly integrated, not something that's kind of slapped on at any part in the process. So if I had a manager that is typically doing that kind of deep value, we're going to engage, we want them to improve over time, and they're now saying to us, we're going to pick the companies that are the real leaders in sustainability, that's something where we would approach that with a lot of skepticism because we don't actually see that as their core investment thesis and process. So, one thing that my CIO consistently says to me is it's your job to work yourself out of a job. And what he means by that is that he wants the principles of ESG and sustainability to be so integrated within the model that they don't need to be this separate or distinct aspect of what we consider our practice at Wespath. And as much as possible, we want to be holding our managers to that same standard.
Yeah, I like that. Well, I don't know how I feel, but that makes sense.
Well, there's still lots of work to do, so I got job security at least for a little bit.
Exactly, a while off.
Yeah.
So Davey, I guess as one of the things we also try to do is advocate for responsible investing in ESG, and a lot of times you guys hear this too. It's like we can't even think about ESG, or ESG in this context doesn't make sense because our fiduciary duty is not to sacrifice return. What has been your experience in terms of sacrificing the return, but also being able to invest with a sustainable mindset in a responsible way?
Yeah, well, we're simply, I mean, we can't sacrifice return. So we have to make a good return even when investing in the green area, or social area, or whatever. It's part of our fiduciary duty, so we're not allowed to, and our financial authorities are very scrutinizing on that regard. So what we've experienced is at least for a number of years, starting back, as I mentioned, in 2011 with the first on and offshore windmill farms investments, that was quite a good business. There were, of course, state subsidies. We had some partnerships also with the state, having a first loss mechanism. So we had an advantage there. We find it more and more difficult to get these investment with these big, I mean, we still make a decent return, but it's not double-digit numbers as it used to be. Then there are areas that, to our complete surprise, turned out to be a good investment, and I'd like to mention microfinance. That was actually our board, members of our board asking, well, couldn't you do something for emerging markets for helping alleviate poverty and so on? So we started to look into that. And it's proven to be a really good business, and at the same time doing a lot of good and also supporting the SDGs. So it's just a win-win-win situation. And not every investment is like that. We try to invest in forestry and can just see that that has not been a good investment. I mean, we were in Australia with the fires, and yeah, so just forestry is not our thing.
And thanks. And Jake, did you have anything to add to that in terms of your experience?
No, I mean, I think Davey was covering it well in terms of how we think about sustainable investment. So nothing particularly, I'll leave it to other questions to add more.
Okay, great. Well, maybe I'll just ask a few questions we have from the audience. And so I guess Jake, this is for you. Have you built a reporting framework to get data and measure engagement with your external mandates, such as your partnership with BlackRock?
So we do use DiligenceVault in terms of hosting a regular annual ESG integration kind of survey, in which we send out an annual survey to our participants and to all of our asset managers. And some of that is basic questions like, have you had any changes in ownership? Have there been any departures in senior leadership? But then we're also asking them questions routinely about how they're thinking about ESG integration, what resources do they have devoted to engagement and stewardship. And so when we think about a reporting framework, part of what the reporting framework is intended, I come from impact consulting, institutional investment consulting before this. And so my inclination whenever I think about reporting is, how does this materially add value to the process? And I think what we found with our ESG integration process is what has most materially added value at times is actually when we anonymize the data that we get from our managers and show them where they compare to their peers. Because I think that there's just kind of a natural competitive element to a lot of these. So when we've shown managers, hey, on this specific item, we're really finding you to be somewhat of a laggard, that has oftentimes been some of the conversations that have inspired kind of action and momentum in terms of them seeing that as a challenge, or coming back to us to help clarify what their positioning is, and oftentimes give us a deeper understanding of what their strategy is. So that's the main mechanism we have right now. I think moving forward, I've been in the role for 6 months, but in terms of engagement with asset managers and building out more routine and regular and sustained engagement with those models is something I'm very interested in, because when I look at my role as a stewardship and engagement individual, to some extent, I think there's a greater multiplier effect. There can be a greater multiplier effect and resonance of my voice as an asset owner with an asset manager than with a company. The company is kind of one order removed in terms of my investment and client in them as Wespath, while it's very real and very kind of front and center for our conversations with BlackRock to know that we're a client, that there is a relationship that's developed there over time. And I think that the accretive value of us having those conversations with asset managers can also be higher in terms of it making us smarter investors over time. So something, you know, that we have definitely a foundation and framework for, but also something that I'm very interested in expanding and exploring.
All right, great. And I think another question for Davey, and maybe we touched on this a bit, but it's around in terms of where you might restrict investing or where you avoid sectors. How are you doing this? Is it via negative screening? Are you taking more of a practical approach, or are you investing in management thematic approach? Just thinking around, I know we touched on this earlier, but do you just avoid all companies that touch coal, or do you approach it in a different way, for example?
Okay, yeah. So in terms of restrictions, yeah, as I mentioned, so there are certain sectors that we simply don't want to, you know, invest in. Again, controversial weapons and tobacco. So they are completely out, and we do get screening on a, I think it's quarterly basis. So for our whole portfolio, to make sure that none of those companies are within our portfolios. And then as to the approach on coal or oil and gas, so coal, this restriction of 20%. So the idea is that if a company gets 20% and above of its revenue from coal, then we don't believe that that company will be able to change. And as I mentioned, until a month ago, that number was 90%. So it's really been decreased. And that, of course, is looking forward to the Paris Agreement, to a CO2 free environment in 2050. So in order to push that, and back to the Climate Plus initiative, going together as investors and trying to push some of these companies, especially coal mining companies, oil and gas companies, also transportation, and so on, trying to get them to move together. I mean, we're the third biggest in Denmark, but we're quite small compared to the rest of the world. So going together with a lot of asset manager through IRGCC, through the UN PRE or net zero, I mean, I think that makes a huge impact. So it's some sectors we just exclude, some it's more a qualitative approach.
Right. Okay, and I guess, Jake, for you, and I think you touched on this in your presentation, but how do you think this COVID crisis will impact ESG more generally? And do you think there's going to be more focus on sort of some of the social aspects of investing that perhaps weren't prioritized before? And maybe you can talk directly in your context and also more broadly, do you see shifts in the general investing environment?
Yeah, so certainly I think that both the coronavirus epidemic as well as the racial justice protests that have been here in the US as well as more broadly are going to heighten the element of a focus on the social component of ESG. I think part of what that'll look like is, you know, for example, within the Human Capital Management Coalition, you know, it was kind of surprising to me when I learned that, you know, companies are only really mandated here in the US to disclose the amount of employees that they have. And when it comes to things like diversity, part-time versus contractor, tenure and turnover of employees, those aren't really commonly disclosed, or they aren't mandated for disclosure, even though those are kind of very material aspects of what we would consider as investors good human capital management. So the HCMC submitted a rule change petition to the SEC that's now under review to kind of have that broader disclosure, which I think is just an example of kind of how far we have to come on some of these issues. And I think that part of it is just that when, as opposed to climate, where there is both a sense of urgency around the very real time constraints that we have in terms of the ability to have action to mitigate climate, as well as broader consensus in much of the world around the causes and some of the solutions to climate change. Social issues are much more kind of amorphous. They're much more complex and intersectional to some extent because they're so embedded within the public sphere, within public policy, within culture and consciousness. And I don't say that to, I think there's a lot of intersectionality between climate and social issues, but it's easier to parcel out climate and really focus on emissions reductions. That's very clear, and companies can make commitments, and there can be kind of largely agreed upon frameworks. So I'll be really curious to see how the conversation evolves in terms of whether frameworks and kind of consensus builds around what progress in social issues looks like over time. We've heard a lot about stakeholder engagement, stakeholder capitalism from groups like BlackRock. I think that that's a pretty complex and multifaceted idea to actually implement in practice. But, I'm hopeful that investors will just be asking more questions, engaging more thoughtfully. I was on an engagement the other day with a company who was talking about their returning back to work after coronavirus. And they were talking about the idea of kind of having a panel of experts, health experts, to help advise them on when they'd return back to coronavirus. And we as the engagement body just kind of suggested, like, hey, shouldn't you have some workers on that panel in addition to a bunch of health experts? Because the workers might know things that the health experts don't. And the company was kind of like, oh yeah, that sounds like a good idea. So I'm not sure that question would have gotten asked. It might have, but I think there's a greater likelihood of those kind of basic questions getting asked, which will help move the needle. And then it'll be really interesting to see if that coalesces into frameworks through which there can be consensus, collaboration, and the building of momentum on these issues.
Yeah, and I would totally agree. Even anecdotally at Aksia, we're definitely getting much more interest from clients on ESG, and internally, just employees themselves and ourselves, the momentum around it is increasing. So, all right. So, David, for you, one of the questions is, what mechanism do you use to measure impact? And I imagine it's specifically around your objectives for the SDGs. And this is a challenge, I guess, mapping the investment performance against trying to meet those SDGs. So, I don't know if you can speak a bit around that.
Well, yeah, I very much agree. It is a challenge. We try to, right now we map them. As I mentioned, we have a huge conference coming up this autumn. So right now we're mapping them and looking at our investments, where do they fit? But one of them is, one of the SDGs that our boards decided to put special emphasis on is clean water and sanitation. And I must admit, we don't have any investments within that area. And should we get some in order to support the SDGs? Well, investment opportunities arise, yeah, of course we are on the lookout, but it's more like guidance. It's not a structural approach. And back to the microfinance, that was actually born out of the talk when our boards decided to adopt those 7. This emphasis on gender equality and poverty alleviation and so on. That was actually born out of that. So sometimes initiatives arise out of a discussion in a boardroom that nobody really had foreseen to start off with.
Right. Well, that's actually a good segue into another question, but along these lines. So, and this will go to both of you, but if we get a government next year in the USA that is much more committed to dealing with climate change, how can the investor community work with a committed government to provide the economic incentives to reduce CO2 emissions?
Yeah, so I'll take a first crack at that question. I think the collaboration with, I think in many ways that the corporate environment has actually already accelerated far beyond where the federal government is. There's a pretty incredible example that I think about of a number of major oil and gas companies here in the US kind of lobbying against the relaxation of methane regulation because they wanted kind of regular and consistent methane regulation. The EPA was coming out with a rollback, and effectively they felt that that was going to be, to some extent what companies want is certainty and a sense of reliability and a sense of, factors that they can plan around. And I think that the consensus has grown, and the PRI has done great work on this in terms of the inevitable policy response, that we are likely to see, prices of some of the externalities of carbon emissions getting priced in some way. And I think the more that companies can advocate for reasonable regulation, certainly not get in the way of that, the better off that we will be in terms of building that political momentum to have the policy piece kick into play. And, you saw that we're co-leads at Wespath on Chevron, and you saw broad investor expression of that in terms of the majority vote for the first time resolution around Paris-aligned lobbying this year, which is, in the engagement space, pretty powerful to have a first-time vote get a majority, first-time resolution get a majority vote. So I think that there is consensus that businesses, for the most part, want to be supporting reasonable policy movement on this, and that there is an increasing investor expectation to do so.
Yeah, I very much agree with what you said, Jake. I think basically, as investors, we are so ready to invest, on the lookout all the time for good investments, and this some kind of certainty, political stability, certainty about regulation. There's a lot coming out of the EU right now on the taxonomy, disclosure, green bond framework, and so on. So the more data we get, the less greenwashing we get. And right now, politically, we're discussing pricing carbon in Denmark. And there's also a political discussion on the EU. So it'll be really interesting to see. And I think that goes direct link to the US, to the new US administration at the end of the year.
Yeah.
I would also just say that I think the chances are still low, but they go up exponentially in terms of the ability to get a picture with me and the head of state, so I can try and step up to what Davey's talking about next time. So I'm personally rooting for that.
Well, we can check in the same time next year and see where we're at.
Fingers crossed.
Yeah, exactly. Well, I think maybe that's a great way to finish it today. I don't know, maybe one more question, or we have a few more minutes. I'll just squeeze in one more question. Davey, for you, or Jake, actually, how do you view investing for impact but doing it through listed equities? Do you think it's possible, or is it really something you can only do on the private side?
Davey, you want to start with that, or?
You go ahead. I'll just have a think.
Yeah. So I would say the way that we talk about it internal to Wespath is that I've heard this saying before, and I think there's validity to it, of all investments have impact. Whether that's positive or negative, or how you measure intentionality and materiality are different measures, but you know, there is a kind of, you are participating in owning economic activity that's having an impact on someone somewhere through your investments. And I think that when you look at kind of acting as a prudent fiduciary that has a mindset, as we do, that there's a need for the transition to a sustainable global economy, you have a lot of different tools in your tool belt, especially, you know, when you are a institutional asset owner. So I think impact is one way to really catalyze new businesses and have really exciting kind of frontier development of some of the economic models and companies that we need to deal with some of these issues. But obviously, we strongly believe in stewardship and shareholder advocacy within listed equities as a very meaningful way to kind of, instead of thinking about that frontier that's being developed by your impact investments, thinking about the way to kind of steer the, you know, the big cruiser ship that's coming behind it, that is the more kind of broad public markets. So I think it depends on what your talents are, what areas you want to get involved in, what your theory of change is as an institutional asset owner. But our philosophy is that, you know, everyone needs to be doing more to step up to these challenges, ourselves included. And so just kind of have it be an iterative and evolving dialogue is the best place to be.
We have a private equity arm within PK, investing very much in impact funds. So might be an SGD fund, an Africa fund, climate fund, wherever, whatever. And putting huge emphasis on both the impact, but also on the ESG, so trying to merge that together. And I very much concur with what Jake said.
Great. Well, thank you guys. I think from my side, you've been fantastic to talk with us today. Maybe I'll just pass it over to Guillaume to wrap it up.
Well, thank you all of you. Thank you, Jake. Thank you, Devi, and thank you, Michelle, for moderating this really exciting discussion. I think there's going to be lots of really good takeaway. So thank you also to everyone who have joined us on the webinar today. We are going to share the poll result next week. We're also going to send out the key takeaways